The surprise Donald Trump win in the US presidential election caused an interesting reaction in the financial markets. This week we saw a wild sell-off followed by a steep recovery in global equity markets. The US dollar tanked against a majority of the G10 currencies, except the Canadian dollar and antipodians, while emerging market currencies sold off as the Mexican peso and Turkish lira hit all-time lows. The S&P 500 index hit the downside limit on election night, while the Dow Jones raised 800 points as the results came in. The heavy headwinds in the worldwide sovereign markets have sent yields and inflation expectations higher across the G10 world. Yet interestingly, risk sentiment this week recovered just as fast as it tanked, with the Dow Jones closing at an all-time high on Thursday. Let's focus on a why for a moment. Now, the newly elected President Donald Trump announced $500 billion worth of infrastructure spending, which has triggered a sharp U-turn in sentiment. If Trump leans towards such an expansive fiscal policy, then the Federal Reserve will have little choice but to step back. Hence, the probability of a December Fed interest rate hike first dropped to 50%, then bounced above 80%. The major players now see at least 2 to 3 Fed rate hikes in 2017, which is a good reason for the US dollar to resume its year-to-date rally. On Thursday, Fed Chair Janet Yellen will be under the spotlight as she will testify about the economic outlook before the Joint Economic Committee in Washington, D.C. Hence, keep an eye on the US dollar as the greenback will again be in traders' focus. Elsewhere, China will release industrial production, fixed asset investment, and retail sales data on Monday. The Chinese yuan fell to a fresh 6-year low against the US dollar, as the Trump victory helped the dollar rally. The upcoming protectionist measures, as promised under Trump's leadership, are expected to hit Chinese activity in the US, as import taxes could be brought up to 45% on Chinese products. Hence, the uncertainty is here to stay, and bad news could cause sharp waves of sell-offs in Chinese equities, which have recorded a decent rally on the back of the commodity rally post the Trump win. Now, last but certainly not least, the UK will announce its latest inflation and employment figures on Tuesday and Wednesday, respectively. The unexpected pickup in inflationary pressures have recently pushed the Bank of England doves on the sidelines, suggesting that the BOE might not stay loose for too long if inflation skyrockets on the back of historically low interest rates and the rising import goods prices, which is obviously due to a significantly cheaper pound. Now, the pound had an interesting trend during the US election week. Range-bound during the wild volatilities, the pound picked up a positive momentum in the post-election era, diverging from the majority of its G10 peers. Cable extended gains to the 50-day moving average against the US dollar for the first time in 3 weeks, as gilt yields recovered sharply, close to the levels last seen in pre-Brexit referendum. A solid inflation report could send the pound back to the levels seen before the October 7th flash crash. That's your quick wrap-up on the week ahead. Now stay tuned to our analysis page on our website, and don't forget to connect with us on social media to keep up to date with all the latest market news and insights. Goodbye.